2024 was really good. Now, if we think about 2025, in the short term, who the hell knows what's going to happen? That's what we all come back down to. It's long-term investing, not short-term gambling. I think this is the year where diversification is really important.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, the Lighthouse Wealth Quarterly Update.
We're back in your life, and Mike, a quarter just goes like that, doesn't it?
I know, and what a quarter it was.
Yeah, so today we will be talking about what happened over the quarter from the start of October to the end of December. We're talking about international shares, international bonds, some properties, some Australian, some New Zealand shares, the whole damn thing. And gold. We're going to be talking about gold.
Back,
Our
baby.
Conspiracy theory friends out there are absolutely going to be loving it on their... It's not Donald Duck. Who's got all the... Scrooge McDuck. Scrooge McDuck has all the gold.
Dives into the pool of solid gold coins.
Yeah, which seems like a health and safety risk personally. So we use this episode mainly for our investment clients at Lighthouse. So every quarter we send out reports, we put together a video. So quick plug, if you do want to talk about your own investments, reach out to us at lighthousefinancial.co.nz. But that's enough of the plugs.
Yeah.
Let's talk about what's happened in the markets, Mike.
Yeah, so in these episodes, I'm pitching the balls and James is hitting them, right? So, James, global equities, talk to me about them.
It's good I'm hitting the balls, Mike, because you're the most uncoordinated man I've ever seen. Global equities over the last quarter have gone up about 2% on a hedged basis.
On a hedged basis. Jimmy, what is a hedged basis?
Hedged versus unhedged, Mike, is going to be a big point of discussion.
Yeah.
So on Wednesday, we talked a lot about Trump, and we talked about how the New Zealand dollar was very soft. And that is what the hedged versus unhedged pieces. So when we talk about shares, which is companies going up in value, if we are in New Zealand buying a US company in US dollars, there's two ways that company goes up. Either the exchange rate goes in our favor or the company performs. So on a hedge basis, that means the company has gone up 2%. On a unhedged basis, 13% for the quarter because of a surging US dollar.
Yeah, zero hedge. You know what it is. Okay, so over the full year, what does that mean so far?
Well, it was just a crazy year for the international share market. 34% on an unhedged basis and 13.5% on a hedge basis. In terms of our portfolios, which is an obvious question, well, what do you do? Do you hedge? Do you unhedge? I like to sit on the fence. 50-50. So we get some of that benefit, but we're also protecting some of the risk.
Cool. And emerging markets, how do they perform?
Emerging markets went up 4.5%. New Zealand equities for the quarter, pretty good for us, Mike. 5.5% because the NZX has not gone anywhere in a really long time. So nice to see, some
Is that just off the back of the currency being so weak though?
It's a good question. I think it's probably a couple of reasons. One is New Zealand, starting to show some signs of improvement. Obviously, the OCR coming down as much as it has from August. You think about August, it's come down, 125 bips? Is that right? That'll start to create some confidence and people want to start to invest some money.
So what were some of the big drivers off that were kind of driving those, and quite, to be frank, insane returns?
So there are a few reasons. The first one is the US economy just kept going. So if we think about New Zealand, our economy, our GDP has been going backwards. We're not growing as a country. The US has not had that problem at all. They've been growing at about 3% a year. There was the expectation that would start to slow down, but that just has not happened. So the thoughts that the Fed would start to cut interest rates, that hasn't happened either. And obviously, things have just kept going.
Yeah, nice. So what are some of the key takeaways for investors here?
A big one is the whole hedged versus unhedged component. So when you are thinking about investing, and this is where, if you've got a reasonable sized portfolio, you might want to talk to a financial advisor about it, is the US dollar really completely changed the performance of the returns. We're pretty much talking, it was essentially 3 times more because of currency movement. And that's probably something that the average investor doesn't think about enough.
Yeah. Was that currency movement Because the US dollar is quite strong, very strong. Is that just off the back of Donald Trump coming in? What's kind of caused that?
Well, I mean, certainly Trump has helped, right? I mean, you took the crypto bros out there as well, and they're very happy. Trump, and plus just the strength of the economy as well would probably be the two biggest ones.
Cool.
The other one that we've really got to take into consideration is the Magnificent Seven, the Nvidia, Apple, Tesla, Microsoft, Facebook, all of those. They are carrying a huge amount of the strong performance. I think it was something like Nvidia was responsible for 25% of the performance of the S&P 500 over the past year. There is some very big chunky companies that are pulling up the total performance of a lot of these markets. And I think we just need to, like Warren Buffett has this really famous quote where it's just like consistently just drip feed into the S&P 500 over time. That's all you need to do. We've done an episode about this in the past with Dean Anderson from Kerner, which we'll put in the show notes. But I think that's a flawed strategy, especially with just how strongly it's performed. This is a really good time where it's not like you don't want to have exposure to the US and these companies, but you do want to diversify. Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
Let's talk about it. I mean, you know my opinions on this. James, gold. What is going on with gold?
So gold over the quarter went up 12.6%, and over a year, 42.5%.
I'm gonna get roasted here.
Now the obvious, so it's the best performing asset if you exclude Bitcoin from the mix. So it's outperformed equities, it's outperformed fixed interest.
That's interesting that it's outperformed fixed income. I thought fixed income would have been going really strong. I was looking at the UBS numbers last night, and their fixed income desk has like out-traded their equities desk.
There's probably the trades versus the performance. And it depends on the type of bonds we're talking about, but they're definitely sitting sub 10, while these shares have performed quite a bit higher. In terms of the gold piece, people buy gold when they feel like they need to move into their bunker and they're a bit worried about what's going to happen next. The geopolitical tensions, inflation spiked after Trump's election. That's like a safe haven where people have started to move to. So it's not too surprising. There's a bit of concern over, inflation hanging around, potential interest rate hikes as well. And central banks as well. They're buying gold as well, which is interesting.
Yeah, central banks being a net buyer is quite interesting. I mean, it reinforces that it is that safe haven, that store of value globally. So, okay, I get it. I tell everyone I hate gold. I still hate gold. Yeah, it's gone up. Blip on the map. It'll still come back down.
I think the big thing as well is when you think about gold price over a long enough period of time, like say 20 years, it's kind of gone like this and then started to go like that. So it's, when you look at it over short periods of time, people can run to it, but I would just be careful and look over longer periods of time to look at the averages.
Yeah, cool. So tactical hedge or a long-term portfolio staple, probably more of a tactical hedge.
Yeah, it's a perfect example of a good alternative asset. You might have like a 5% allocation. If shares start to perform poorly, gold might perform well.
Cool. Alrighty. So then let's look at some of the biggest losers. Listed property. James, what is going on with global listed property?
Well, Mike, I probably don't need to tell you
REITs
that interest rates have been high to deal with inflation. And that just means property is just an unattractive asset. And it's just interest rate sensitive. That's really all it comes down to at the end of the day. So it's not surprising that it dropped 7.5% over the quarter. I mean, you think about how much it's dropped. At some point, you hope it turns around. But not really that surprising, I'd say.
Yeah, I think it's one of those things where for the economic climate, it is the opposite to gold, right? Like the economic conditions for property, none of it is surprising that it's dropped 7.5% over the quarter because it's just not the right time for them. For gold, flight to safety, uncertainty out there politically, globally, economically, it is the right time for gold, right? So again, just those market forces moving, you've got one on one end, one on the other.
Yeah, and it's a perfect example of why diversification is king, because you go, all right, the S&P 500 has increased about 90% over the past 5 years.
Yeah.
What do I think is going to happen, next? Once again, if you think about what's happening next, you're thinking the wrong game. But having some exposure to property, having some exposure to bonds, where their interest rates are at a decent level, where you're getting paid a reasonable return, not a bad thing at all.
So thinking about some key takeaways for investors there, we all know the saying, buy low, sell high. Global listed property, REITs, is it now the time to buy that?
I think there's still the question. Obviously, there's a lot of things happening in the world at the moment. If we're looking at the US, inflation, interest rates, it's not like they're definitely coming down tomorrow.
Yeah.
I think it's a really good point that it's a good part of a portfolio to have. Maybe you have like a 10, 15% allocation to it. But my big thing, which we'll get to as kind of a summary, is you should not be, you can tinker with your asset allocation. So asset allocation is going, how much do I have, in shares locally, in bonds locally and overseas, a bit of property, etc. You've got your asset allocation. You can have a tactical asset allocation.
Yeah.
So that might mean that you change how much that you have by 5% or something. Maybe you hold on to a bit more cash, but it's not like we should be having huge swings towards property, because we do know if we look at the performance of each asset each year over long periods of time, it's not like
and
it's not like the worst one is necessarily the best one each year, which is why we play the long-term game and we're not day traders, because we know the stats around that.
Just about to say, then you end up day trading. All right. So what are some final thoughts for our listeners? What does this mean for 2025, James? What are we thinking?
Yeah, I mean, it's so 2024 in terms of the performance of portfolios was really strong. So if I quickly run you through some numbers, our growth portfolio over the past 12 months has moved up about 15.8%, which is a really strong number. And that's 70% in shares and property. So if you think about the property element, right, that hasn't performed as well. That pulls us back a little bit. And then we've got 30% in bonds and cash. They're doing okay. They're probably like somewhere between like the 5 and 8% sort of number.
Yeah.
So 2024 was really good. Now, if we think about 2025, in the short term, who the hell knows what's going to happen? That's what we all come back down to. It's long-term investing, not short-term gambling. I think this is the year where diversification is really important. If we think about those really big companies like the NVIDIAs, the Teslas, all those ones, you go, a lot of them are already well overpriced. But who knows? The big thing though is I think this is where the diversification into property, into bonds, New Zealand shares, you could argue some value. Australian shares have some value as well. Another one just to add on, which is a really interesting side story, is have a look into Rocket Lab. Rocket Lab is a really interesting one in terms of New Zealand, where they listed about, I think 2 years ago, and they fell to about $3.
Listed at about 12, fell to about 3.
And now they're at about $30. So they're not listed in New Zealand, they're listed in the States, but obviously very strong ties to the New Zealand economy. Really interesting to see what happens there as well.
Yeah, I think probably one of the good points there is, if you look at those Magnificent Seven, the fundamentals around the stock and what the price should be are completely divorced from what the actual price of the stock is now. So there is huge risk there, but at the same time, there could potentially be huge upside. Diversification here is absolutely key. You can't just look at something and be like, that's performed really well, I'm going to tip all of my eggs into that bucket.
Yeah, for sure. So for our customers out there listening at Lighthouse, we will send you your quarterly reports off the back of this. If you've got any questions, reach out, contact your financial advisor. We'll have another financial review very soon. For those out there who are thinking about their investments, a lot of moving parts in there. My big suggestion is just make sure, like Mike said, we are well diversified. We are thinking long term. We aren't thinking short term. Thank you very much for joining us. Much love to Partners Life. Please make sure to subscribe, give us a like, give us a review, and we'll catch you next time.